Imagine it's 14th of July, 1980. You are a 44-year-old tool and die maker living in Cleveland, United States. You own a small brick house with aluminum siding, a dented mailbox, and a kitchen window that looks out onto a narrow yard. Every Friday, you put a little money into a savings account and a little into the employee stock plan at the factory, because that is what careful men do. Your wife keeps grocery coupons in a coffee tin beside the phone, and on Sundays you read the business pages at the breakfast table and circle the company names you trust. You are not rich, but you are steady. You think steady people are supposed to be safe. If you have ever wondered why a stock market can seem alive while an entire society feels poorer, stay with me. What you are about to hear is not a theory. It is a pattern. It has happened before in different countries, under different flags, in different decades. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. Then one summer the numbers stop making sense. The gas station down the road changes its sign so often it feels like a clock. The grocery bill rises between one paycheck and the next. The interest on mortgages pushes toward levels that once sounded impossible. And even though the stock market still exists, still prints quotes, still gives people something to talk about over lunch, it no longer feels like a safe machine that quietly turns patience into security. It feels like standing on a dock while the tide keeps rising under your feet. The boards are still there, but the water is already at your ankles. That is what this video is about. Not whether stocks can rise during inflation. They can. Not whether businesses can pass on higher prices. Some can. The deeper question is what high inflation really does to stock markets over time. History shows that high inflation changes the ruler itself. It makes stock prices look healthier than they are. It crushes broad market valuations, which means the prices investors are willing to pay for profits, even when company sales are rising. It rewards some firms for a while, especially those with hard assets, export income, or the power to raise prices fast, and it quietly destroys everyone who confuses nominal gains, gains measured in falling money, with real gains, which are gains in actual purchasing power. In calm years, that difference feels small. In inflationary years, it is the whole story. Before we go further, there is something important to understand. Looking at stocks during high inflation without adjusting for inflation is like measuring your height with a rubber ruler. The numbers may go up, the ruler is still lying. Inflation is simply the general rise in prices over time. In plain English, it means money buys less than it used to. If a loaf of bread used to cost $1 and now costs $2, the dollar did not stay still, it shrank. Stocks are pieces of businesses, so many people assume they must naturally protect you. After all, if prices rise, companies can charge more. That sounds reasonable. Sometimes it is even true. But between the business and the shareholder sits a whole chain of pressure. Costs rise, wages rise, borrowing costs rise, bond yields rise, taxes bite into gains that are partly just inflation. And the market starts discounting future profits at a higher rate. Discounting is a simple idea with a fancy name. It means investors decide what tomorrow's profit is worth in today's money. When inflation and interest rates jump, those future profits get marked down, sometimes brutally. A dollar expected 10 years from now starts to look thin and far away, like a lantern in fog. That is why long-duration stocks, companies valued mostly on profits expected far in the future, often suffer most when inflation gets hot. There is another trap. During high inflation, companies can report bigger sales and sometimes even bigger profits in money terms, while shareholders are getting poorer in real terms. The numbers get louder as the substance gets thinner. It is like watching a man add stories to a house while termites are eating the beams. From the street, the building looks taller. Inside, it is less safe. Once you understand that, the history of inflation in stock markets stops looking random. It starts looking like the same machine wearing different costumes. The first thing high inflation does to stock markets over time is drag them into a long war against reality, and the classic case is the United States between the mid-1960s and 1982. Americans remember parts of this era in fragments. Gas lines, Nixon on television, wage and price controls, Paul Volcker. But put those pieces together and a very clear pattern appears. According to Federal Reserve history, the Great Inflation lasted from 1965 to 1982. By the summer of 1980, inflation was near 14.5%, while unemployment was above 7.5%. That mix later earned the name stagflation, which means high inflation and weak growth happening at the same time. It sounded unnatural because it was. The economy was supposed to slow inflation when it cooled. Instead, both pain and prices rose together. For the ordinary American investor, this was a slow squeeze, not a single dramatic crash. That is why so many people misremember it. The New York Stock Exchange Index in nominal terms, the ordinary headline number, was just under 500 at the start of 1966 and around 615 by July 1982. On the surface, that looked like a gain of roughly 23%, 16 years, a gain. Not exciting, but not apocalyptic either. Yet once inflation is stripped out, the picture changes completely. One long-run inflation-adjusted stock series shows that the same broad market fell about 59% in real terms from 1966 to July 1982. Not because capitalism stopped, not because every company failed, but because the measuring stick was melting. Look at what happened inside daily life. Households faced 4 recessions during the broader period, severe energy shortages, and a growing sense that official promises no longer matched lived experience. By the late 1970s, the public had come to expect inflation itself. That matters. Inflation is not only a rise in prices, it is a rise in doubt. Once people expect money to lose value, they behave differently. Workers demand higher wages. Businesses raise prices in advance. Lenders demand higher interest. Investors insist on lower stock valuations because cash in the future now feels less certain. The whole system becomes a hall of mirrors where everyone is trying to move first. This is where many viewers make a natural mistake. They say, if companies own factories, brands, equipment, and inventories, should they not be worth more when prices rise? In very long stretches, sometimes yes, but the path matters. In the 1970s, the market did not reward the average listed company simply for existing in an inflationary world. It punished uncertainty. It punished profits that could not keep up with costs. It punished future earnings when treasury yields and interest rates offered investors a higher immediate return elsewhere. Stocks had to compete not only with inflation, but with newly attractive cash yields and bond yields. When safer assets begin paying more, the market stops giving expensive prices to uncertain future growth. That is why inflation often crushes price-to-earnings ratios, or PE ratios. A PE ratio is just how much investors will pay for each dollar of profit. In hot inflation, they usually pay less. And there was one more insult. Taxes were charged on nominal gains. That means investors could pay tax on an apparent profit even when inflation had already eaten the real gain. It was like being told you had grown richer because your bucket was fuller, while nobody mentioned the bucket now had a hole in the bottom. This brings us directly to the central lesson of the American case. High inflation does not need to produce a permanent stock market collapse to do serious damage. It only needs to keep investors running hard enough to stay in the same place while prices outrun them. That kind of loss is quieter than a crash. It is also more dangerous because people call it survival, while it is happening. Here is something I want you to think about before we go further. If your stock portfolio rises, but your food, fuel, rent, and borrowing costs rise even faster, are you actually getting wealthier, or are you just watching numbers float on a sinking currency? Drop your answer in the comments. Seriously. Because what I'm about to show you next is the part of this story that most people never hear, and it changes everything. The second thing high inflation does is expose which markets are merely expensive and which ones are truly fragile. And few examples are more brutal than Britain in the early 1970s. If the American story was a long squeeze, the British story was a trapdoor. In 1974 and 1975, the United Kingdom entered a period of stagflation so severe that GDP turned negative, inflation surged, and the old confidence of post-war stability broke apart in public view. House of Lords research shows inflation reached 16.0% in 1974 and 24.2% in 1975. GDP growth was minus 2.5% in 1974 and minus 1.5% in 1975. Unemployment rose as output fell. Oil prices had risen roughly fourfold between 1972 and 1974. The country even endured the 3-day workweek when electricity shortages and industrial strife forced large parts of business life into an exhausting half-light. Now here is where it gets interesting. British stocks did not simply drift lower. They were crushed in real terms. Long-run market history compiled from British data shows the stock market bottomed in 1975 after a 77% decline in real terms from 1972. Think about that for a moment. A fall of that size is not a bad season. It is a demolition. It means that an investor who thought he owned a solid stake in British enterprise discovered he owned a claim on profits being pounded from every side at once. Input costs rose, wage pressure rose, financing costs rose, consumer confidence fell, and the market did what markets always do when fear and higher discount rates combine. It slashed the price people were willing to pay for uncertain future income. Imagine a shopkeeper in Birmingham or a retired engineer in Leeds who had spent years buying reputable shares for income. He may have believed he owned the safest corner of the private economy. Instead, he watched two storms collide. One was inflation, which ate the value of money in his pocket. The other was valuation collapse, which crushed the market price of the very shares he hoped would protect him. It was a double tide. The shore moved out while the boat sank. Ordinary life during this period tells you more than any chart. Homes were colder, power was less reliable. Labor disputes stretched from factory floors into cabinet rooms. The government increased spending sharply in an attempt to shield households and industry from the crisis, but deficits widened. That helped people in some ways in the short run, yet it did not remove the underlying problem. The system was trying to pay today's bills with tomorrow's confidence. High inflation is often described as heat, but in real historical episodes, it behaves more like steam inside a closed engine. Pressure builds everywhere at once. Seals weaken, gauges spin. Nobody looking at a single dial understands how close the machine is to rupture. And notice the market lesson here. High inflation does not hit every stock market the same way in calendar terms. In Britain, the blow was faster than in the United States. But the mechanism was familiar. Higher inflation led investors to demand higher returns. Higher returns meant lower valuations. Weak growth meant less faith in future profits. Add political strain, energy shock, and loss of confidence, and the market did not act like a protector. It acted like a magnifier. The losses in share prices were real. The losses in purchasing power were even more real. This leads to the second part of the deeper story. When inflation gets high enough, the market may still soar in nominal terms and still fail the average saver. Brazil in the 1980s and early 1990s shows why. If Britain looked like a trapdoor, Brazil looked like an escalator set on fire. Prices did not merely rise, they raced. A long-run study of the Ibovespa, Brazil's main stock index, found that inflation went from three-digit annual rates in the 1980s to four-digit rates before the mid-1990s. Inflation reached 1,000% per year in January 1989 and then peaked at 6,121.3% in April 1990. The country became so used to rewriting the face of money that 12 zeros had to be removed from the Ibovespa between 1983 and 1997 just to keep the numbers readable. At first glance, this seems like the perfect argument that stocks beat inflation. After all, Brazilian equities sometimes exploded upward in nominal terms. The Ibovespa hit a record high in April 1986 after gaining about 1,400% in only 40 months. Later, by February 1994, it had regained almost all of a previous collapse, with a gain of around 1,600% in the period. Those numbers sound like fantasy. For anyone reading them without context, they sound like a ticket to wealth. But hyperinflation, which means prices rising so fast that money loses value almost as you hold it, turns big stock gains into a language problem. A portfolio can look magnificent in the local currency and still leave you exhausted, unstable, and frightened in real life. Look at what happened next. In 1990, the worst year in the history of the Ibovespa, the index plunged 74.1%. The following year, it surged 316.4%. That kind of movement is not healthy wealth creation. It is the financial equivalent of a fever patient swinging between chills and delirium. Prices no longer carry calm information. They carry panic, policy rumors, currency fear, and survival behavior. High inflation did not abolish the stock market in Brazil. It transformed it into a battlefield where timing, policy shocks, and access mattered as much as business quality. What did ordinary Brazilians experience? They lived in a world where salaries were spent quickly because waiting meant loss. Labels in stores became temporary suggestions. Accountants, shop owners, and households all learned to think in moving numbers. Businesses that could turn inventory quickly or raise prices fast had a chance. Businesses with slow contracts or regulated prices were trapped. Savers who kept cash were bled. People with access to indexed instruments, hard assets, foreign currency, or certain kinds of equities had a better chance of keeping up. The stock market became less like a steady orchard and more like a fruit market in a storm. If you knew which crates would spoil first, you survived. If you assumed yesterday's price would still mean something tomorrow, you lost. But here is the part many people miss. Over a very long stretch, Brazilian stocks did deliver a real inflation-adjusted annual return of about 6.71% from 1968 to 2017, according to the same historical study. That is important. It means stocks can preserve and build wealth through inflationary eras over long periods, but it also means the phrase over long periods is doing almost all the work, because between those endpoints were years of chaos, policy shocks, deep losses, and wealth transfer. History does not show that stocks are a magical shield. It shows they are an uneven shield. In some moments they protect, in others they crack, and this is where history gets uncomfortable. Most people will never know what you now know. Most people will keep trusting systems they do not understand. If you are still here, you are not most people. Hit subscribe, because the next section is the part this channel was made for. the part they never put in textbooks. Now look at all three together. The same mechanism. Different countries, different decades, same result. In the United States, inflation hollowed out real returns over 16 long years, even while the broad market appeared roughly stable in headline terms. In Britain, inflation and weak growth smashed valuations so hard that equities lost about 77% in real terms between 1972 and 1975. In Brazil, stocks could soar by the thousands of percent and still leave ordinary people living in a state of permanent financial motion sickness. At this point, the pattern becomes impossible to ignore. High inflation changes three things at once. First, it changes the unit of measurement, so prices in money terms start lying to you. Second, it raises discount rates and bond yields, which lowers the price investors are willing to pay for future profits. Third, it separates businesses by speed and power. Firms that can reprice quickly, own real assets, earn foreign currency, or carry manageable debt often hold up better. Firms with fixed contracts, slow price adjustment, fragile margins, or profits far out in the future often suffer more. This is why inflation is not just a market event. It is a sorting machine. If you want the extreme version, look briefly at Weimar Germany in 1923. In January that year, $1 bought about 17,000 marks. By December, it took roughly 4.2 trillion marks. A pound of rye bread cost more than 100 billion marks by November. Meat reached 3 billion marks a pound. Butter cost twice that. In that world, stock prices and paper marks could rise and still fail to rescue the average family, because the currency itself was collapsing faster than people could think. Wages turned worthless within days. Mothers raced to buy food before prices changed again. Pensioners sold belongings for meals. The middle class fell downward through the floorboards. This is the final form of the same illusion. The ticker can move up while society moves down. And if that feels too distant, history rhymed again in a milder form in 2022. U.S. inflation peaked at 9.1% in June, the highest since 1981. By the end of the year, the S&P 500 had fallen 19.4%, the Nasdaq 33.1%, while value shares held up much better than growth shares, and the energy sector gained 59%. Different scale, same pattern. When inflation rises and rates rise with it, the market stops rewarding distant dreams and starts rewarding current cash flow, hard assets, and pricing power. It does not mean every high inflation episode ends the same way. It means the plumbing is recognizable. Once you have seen the pipes, you stop being surprised by the leaks. So who gets hurt the most when high inflation works its way through a stock market over time? Not always the people you expect. The biggest losses often land not on reckless gamblers, but on people who behave responsibly in ordinary times. Pensioners, salaried workers, families who hold cash buffers. Middle-class savers who buy broad stocks slowly and assume patience alone will protect them. Inflation is especially cruel to anyone whose income adjusts slowly while prices adjust fast. It is a tax collector that visits the quietest houses first. Look at Germany in 1923. People on fixed incomes were devastated. Pensioners sold possessions for food and then went hungry when the possessions ran out. Workers were somewhat safer at first because wages could be renegotiated more often, but even they fell behind as prices accelerated hour by hour. The social damage was not limited to bank accounts. It rearranged status. A teacher, a clerk, or a retired civil servant could obey every rule of respectable life and still find himself sliding into poverty while speculators, traders, and people with access to foreign currency moved faster. Look at Argentina in 1989. Inflation for the year hit 4,123%. By July, according to IMF historical material, inflation was running at roughly 100% a month. In January 1990, when the Buenos Aires Stock Exchange reopened after a closure, prices plunged 53% in a single reopening session. Real wages were about half their level of a year earlier. Supermarket prices were jumping so quickly that businesses tried to sell first and pay suppliers later. Investors fled into dollars. Few people trusted stocks as protection. Few companies trusted the market as a source of real capital. That is another hidden effect of inflation. It does not only hurt portfolios, it damages the market's social function. Instead of being a bridge between savings and productive investment, the stock market becomes a frantic side street where people run for cover. The middle class often discovers the truth last, because in ordinary times the middle class is trained to trust paperwork, a pension statement, a brokerage slip, a savings passbook, a salary review. Inflation turns those documents into photographs of a house that is already burning. In the United States, between 1966 and 1982, the broad market could show a modest headline gain, while real purchasing power was falling hard. In Britain, a careful saver could own reputable companies and still live through a 77% real market collapse by 1975, while inflation ran above 24%. In Brazil, paychecks were often spent almost immediately because waiting was another form of loss. The same social class that is praised for discipline in stable times becomes the easiest class to strip in unstable times, because it holds claims on the future rather than bargaining power in the present. This is why pensioners and office workers appear again and again in inflation history. Their income is sticky. Sticky means slow to change. Prices are not slow. Prices move first. A retired person cannot renegotiate a pension at the speed a butcher changes his sign. A clerk cannot reprice her monthly salary the way a trader reprices inventory. A school teacher cannot hedge her household budget every afternoon. So inflation widens the gap between the financial world and ordinary life. On paper, markets remain open. In the kitchen, the arithmetic stops working. There is also a psychological wound that charts barely capture. When a stock market falls in a clean crash, people know they have been hit. When inflation erodes them slowly, they keep hoping the next raise, the next dividend check, the next government plan will make up the difference. That hope delays adaptation. It keeps families loyal to habits designed for stable money. They save the wrong way for too long. They lend to the future when the future is paying them back in weaker currency. Inflation is not just a thief, it is a hypnotist. It makes people stand still while their position is being moved. Small business owners often suffer in a special way. People imagine business owners always benefit from inflation because they can raise prices. Some can, many cannot. If your suppliers demand cash now, your customers resist higher prices, your taxes are based on nominal figures, and your loans reset upward, inflation feels less like a tailwind and more like being chased uphill. The bakery owner, the mechanic, the local manufacturer, the shopkeeper with thin margins, these people live in the gap between rising costs and delayed payments. In inflation, that gap can become a grave. Who walks away better? Historically, not because they are smarter in every way, but because their position fits the environment. Owners of businesses with strong pricing power. Exporters earning harder currencies. People holding real assets, meaning assets tied to physical things or contracts that adjust with prices. Some debtors can even benefit if their debts are fixed in money that later becomes worth less, though that depends on timing and interest rates. In Brazil, firms that could turn inventory quickly and adjust prices fast had advantages. In the United States in 2022, value sectors with current earnings held up far better than long-duration growth names. History shows that inflation does not reward virtue. It rewards speed, flexibility, and insulation. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. Now we come to the final practical lesson, and it is not a prediction, it is a pattern. The historical record shows that those who came through inflationary periods with the least damage largely shared three characteristics. First, they understood the difference between nominal return and real return. They did not celebrate numbers just because the numbers were bigger. They asked the only question that matters in an inflationary era: what can this money actually buy now? That sounds obvious. It is not. In every high inflation episode, millions of people stared at larger figures and mistook motion for progress. They were like sailors cheering because the waves were higher, without noticing the ship was taking on water. Second, survivors tended to own things that adjusted faster than the currency failed. Not always stocks in general, but specific kinds of businesses, specific contracts, specific assets, and sometimes foreign currency claims. In Brazil, access to indexed instruments and fast-moving businesses mattered. In Argentina, many people ran to dollars because local money no longer held trust. In the United States, sectors with current cash flow and pricing power fared far better than speculative growth names when inflation and rates rose. In plain English, the people who survived best were often the ones standing closest to the cash register and farthest from promises about the distant future. Third, they stayed suspicious of official calm. That does not mean panic. It means they watched the structure, not the paint. In the United States in the 1970s, those who understood that inflation was compressing real returns did not confuse a flat index with preserved wealth. In Britain, those who saw that soaring prices, falling output, and energy shock could combine into a valuation collapse were less likely to trust yesterday's sense of safety. In Weimar Germany, the winners, if that word can even be used in such a human disaster, were often those holding foreign currency, real goods, or businesses tied to something sturdier than the mark. The common thread was not genius. It was refusal to let the currency narrate reality, and this is important. None of this means stocks are useless in inflation. History says something more nuanced and more unsettling. Over long periods, equities can be one of the few assets capable of rebuilding real wealth after inflationary damage. But during the inflation itself, Broad stock ownership is not a magical force field. It can be a bruising, confusing, deeply unequal experience. Some investors come through stronger. Many spend years merely trying not to drown. Collapse is not always a fire. Sometimes it is a shoreline moving so slowly you only notice when the front steps are underwater. So let's go back to Cleveland in July 1980. The tool and die maker at the kitchen table was not foolish. He was living inside a historical pattern that hides itself from ordinary eyes. He saw stock quotes. He saw pay raises. He saw numbers on paper that seemed larger than before. What he could not easily see was that the currency beneath those numbers had been thinning like ice in late winter. If he owned the wrong assets, or owned the right assets but needed money at the wrong moment, inflation could turn years of discipline into a long retreat. If he stayed employed, kept buying through the pain, and lived long enough for the inflation to break and the long bull market after 1982 to begin, he might recover and do well. But the waiting itself was part of the cost. 16 years is not a footnote in a human life. It is a childhood. It is a marriage under pressure. It is the difference between retiring secure and retiring tired. That is what high inflation really does to stock markets over time. It distorts prices, it compresses valuations, it rewards some businesses and punishes others. It creates the illusion of gain while shrinking real wealth. It does not treat the stock market as a shield. It treats it as a battlefield, then lets history decide who mistook noise for safety. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will dismiss it. But if one person in your life needs to hear this, share it with them. Not because it will change the world, because it might change their world. Subscribe for more, and I will see you in the next one.